Hello, I'm Matt Lampert.
Greetings, I'm Robert Folsom.
Welcome to Pop Trends Price Culture, the videocast about social mood, culture, and financial markets. That's what the field of socionomics is all about. Now, our topic today is risk. We'll talk risk in financial markets, risk in business, and some risk we face in everyday life.
Well, Matt, risk is a word we all use, and we think we understand it, but coming up with a useful definition can be a challenge. Risk is abstract because it refers to future negative outcomes, which are uncertain, as in, something bad may happen. How do we anticipate how much risk we face? And that's why the word risk often appears in phrases like risk estimate and possible risk and potential risk and risk exposure. Insurance companies use complex actuarial tables to calculate life expectancy, and by doing that, limit the risk of selling a life insurance policy. In other words, guesswork or a sloppy estimate will make a bad outcome even more costly.
Well, and Robert, just listening to you talk there, I'm reminded of the distinction that some economists make between uncertainty and risk. They talk about uncertainty means there's something that bad might happen, but we don't know what the probability is, whereas they talk about risk to mean something bad might happen, and we have an idea about what that probability could be. But as you point out, it often is in the area of an assessment, of an estimate. And sometimes even when analysts think they've done a pretty good and precise job assessing risk, they can be off significantly. There's a powerful example of that in the study of financial markets, where analysts thought that they had a great understanding of the probability of, say, a market crash, only to find out they were off by let's just say off by a lot. For decades, the dominant way that scholars described how prices fluctuate in the stock market was based on something called a random walk model. And the simplest version of this model treats each time period's price fluctuation, so we'll say each day's fluctuation, for example, as though it was a random draw from a normal probability distribution. And the problem is that stock market price changes don't follow a normal distribution. So when you use the wrong distribution, when you use this normal distribution, the classic bell curve, to model stock price changes, you end up grossly underestimating the risk of a crash.
Yeah, because we're talking about human behavior, which is nonlinear, and it's really hard in linear models to account for that. In his book, The Misbehavior of Markets, Benoit Mandelbrot broke it down kind of like this. He said that there was a month in 1998, one month when the Dow Industrials had 3 trading days with a loss of at least 3.5%. And Mandelbrot said, under standard theories, as it's taught in the business school world, the odds of just one of those declines in that month was something like 1 in 20 million. And he said, it's an event, if you traded for 100,000 years, you wouldn't expect to see even once. And in turn, he said that under a normal distribution, the kind you're talking about, the odds of having 3 of those large declines in the same month would be about 1 in 500 billion. Now, Matt, we know that daily declines in the 3 to 6% range in the stock market, they're uncommon, but they are not so rare that you're going to wait 100,000 years to see it.
Well, no, you certainly don't have to. In fact, in March 2020 alone, the Dow had 7 daily declines in excess of 3.5%. So the question, have we just been phenomenally unlucky in the markets, or is it the case that the standard assumption that stock prices are normally distributed is wrong? Well, it's clearly the latter, and academia has been catching up to the solution to this problem. And frankly, Robert, it's a problem that has real-world consequences.
Well, anticipating real-world consequences, that's how fund managers and financial advisors are supposed to construct portfolios. If they want to build a portfolio that can withstand a once-in-a-century crash, right, then they need to calculate scale, how big a crash to prepare for. And that's the financial equivalent of trying to engineer a dam to withstand a once-in-a-century flood, only for experience to prove that such a flood like that can happen more like every 5 years or so.
Yeah, exactly. And so one big improvement that people like Mandelbrot and Nassim Taleb have popularized, and it's really happened over the past 20, 25 years where this has really come to the fore, uh, is that understanding that unlike a normal distribution, the distribution of stock price changes, and the price changes for financial assets more generally for that matter, have what statisticians call fat tails, or if you want a word for your next game of Scrabble, the technical term is leptokurtosis. It just means that events that are relatively infrequent in financial markets are not nearly as infrequent as you'd expect under a normal distribution. They happen way more often. So in other words, the real world markets are much riskier than economists had realized.
Right. And, I'm all for improving the understanding of economists, they have of financial markets, but that didn't seem to help them or help most everyday people for that matter. Didn't help them dodge the market declines of 2000 through 2002, 2007 through 2009, or the flash bear market of 2020.
Yeah, well, that's right. And this is where the Elliott wave model becomes so important because the realization that financial markets have fat-tailed distributions, that's important, but it doesn't go far enough. R. Elliott figured out something in the 1930s that was so ahead of his time. I mean, we're talking decades before Mandelbrot's work, decades even before modern computing. And he figured out that stock market price fluctuations are drawn from a probability distribution that changes and changes according to a particular pattern. And this revelation is crucial. And frankly, modern day scholars still haven't really caught up to where Elliott was back in the 30s.
Yeah. Usually when socionomists talk about R. and Elliott, talk about Mandelbrot, they point out that R. and Elliott observed how fluctuations in financial markets, they form fractals. And Elliott did that decades before Mandelbrot did. Now, what we're talking about is something that Elliott had actually discovered, and that Mandelbrot still has not caught up to.
No, he never really caught up to this idea. Now, of course, Elliott did not describe his model in terms of probability or distributions, but it's a natural implication of his model. And if you understand the wave principle, then what I'm about to say will make all the sense in the world. So if we consider like a large degree financial market crash or a huge bear market, say of at least super cycle degree, that's a bear market qualitatively on par with the 1929 to 32 crash, for example. Well, the odds of that happening under the wave model basically round to zero most of the time. It's just not something you're going to see. But there are specific junctures in the market where a decline like that is not only possible under the wave model, but it is in fact the most likely development.
Right. In other words, the probability of a negative outcome in the market, that changes as the pattern unfolds. And it's not enough to know that a distribution has a fat tail. To understand market risk at a given time, you also need to know how that probability distribution has shifted. Otherwise, what you end up with is the same, grossly underestimated risk of a big decline.
Right, you find yourself right back into that same problem that you thought that they thought they had solved by figuring out the shape of the distribution. But another aspect of this, Robert, frankly, when we start talking about a crash or a big decline, is that the herding impulse compounds the problem immensely because we know that big bear markets start where big bull markets end. And it's at the end of those large degree bull markets when social mood is at a positive extreme. So that means that societal optimism is likewise at an extreme. And with that tide of overwhelming optimism, just the notion that a big bear market could be around the corner, that feels pretty unbelievable.
Right. And that's exactly why even economists routinely downplay the risk of a bear market or a recession just before that event arrives. Their analytical model of markets, it underestimates risk, so they habitually fall prey to joining the crowd psychology, which itself underestimates risk at the worst possible time.
Yeah, they're right there, cheer the market, getting extremely optimistic, just like everybody else, right there at the market peak.
Right. Longtime viewers, they know we've talked about this before, and Matt, you covered it in the February 2023 issue of the Socionomist. And what we can emphasize today is that when it comes to risk in financial markets, you need a good analytical model and you need a good psychological model of markets. If you have both, then you're better equipped to diagnose market risk. Otherwise, like economists, you'll end up saying things like, yes, there's been booms and busts before, but this time it's different. This time we'll have the boom and not the bust.
I mean, that's the classic Irving Fisher permanently high plateau line.
Yeah, as you know, in the socionomic theory of finance, Bob Fractals explained that investors act to reduce their feelings of risk in the market. But then comes the siren song of social mood, and that distorts their perception of what their risk truly is in the market. And our perception of risk is the most misaligned when the extremes come in the trends. In other words, the very time your understanding of risk needs to be the sharpest.
And Robert, we're talking here about our feelings of risk in the financial markets, but we can zoom out and use some of the same principles to talk about our feelings of risk generally. I mean, at a peak in positive mood, the world usually looks and feels pretty peaceful, feels pretty prosperous, and in that environment, it can be difficult to imagine that times are about to get far more challenging, not just in the markets, but in the economy, politics, and even in terms of things like the safety and security of your own neighborhood.
Right. And business leaders obviously confront these consequences routinely when a bull market peak becomes a bear market, and the optimism of positive mood extremes inspires businesses to expand and to borrow. Times are good, so decision makers extrapolate today's good times into tomorrow. When the trend instead becomes a big bear market, the revenue and the profit that the decision makers expected would be there, that's vanished, and that means their businesses can vanish too.
This is so important, and we're really getting into where a socionomic perspective can help with corporate risk management. And Dr. Salvador P. Berrigan wrote a great article on exactly that theme in the March 2023 issue of the Socionomist. If you're a Socionomics Premier member, you can check that out in your online member portal. And Robert, before we wrap up, maybe we should consider a little bit more about risk in everyday life. I mean, you did a podcast on that theme a number of years ago, and I remember one of the points you made was that as humans, there's a temptation to overestimate the risk associated with intentional acts and to underestimate risks associated with things like accidents and natural developments.
Right. And people, if something's front and center in your mind, it becomes more conspicuous somehow when you look out into the world. One example, the NYPD tracks all reports of suspicious packages. Well, the daily totals of those reports, they typically spike at multiples of 4 or 5, right? On days when terrorist actions make headlines, but on a day when, let's say, an F5 tornado levels 200 homes in Oklahoma, you don't see a spike in suspicious package reports. And this is not, of course, to make light of suspicious packages or terrorism. It's evil. What I'm suggesting is it helps to think about what really does threaten your safety and your health and your life. I'm afraid of food poisoning because the data says I should be. I'm afraid of falling from a ladder. I'm afraid of heart disease. Risk is contextual. Transportation, to weather, to other people, right? I had a great aunt. She smoked like a locomotive, but she stayed healthy and active well into her 80s. But the data tells me that my blessed great aunt, she was an outlier. Her individual story is an anecdote. It doesn't change my risk estimate of smoking tobacco.
Right. Yeah. I mean, as you say, statistically, those health issues and accidents are considerably more likely to strike. And if you understand those risks, then you can be aware of them and maybe even do some things differently to make them less likely to strike you. So, things like eating a good diet, avoiding cigarettes, staying off the ladder, or at least having someone hold on to it when you climb up.
Catch you on the way down. There's one other important risk that people too often underestimate, and that's politicians who will exploit the public's fear. We know that when mood turns negative, fear runs higher, and in that environment, in that mood environment, the public has supported many, many times policies that in hindsight are just nakedly indefensible. I'm not gonna name any recent examples. Our viewers know what we're talking about. As for other examples from history, we've also talked in previous episodes about the eugenics movement in the early 20th century, the Cultural Revolution carried out by Mao Zedong in China, spread of McCarthyism in the U.S. The role of social mood in those events is very real, and socionomists don't underestimate it.
That's right. Hey, we do our best to get it right when it comes to revealing, the risk associated with these sorts of events and the way in which social mood shifts that risk as it unfolds. That's a great point. All right, let's wrap things up for today. To our viewers, thank you so much for watching. If you have some feedback for us, feel free to get in touch. The email address is institute@socionomics.net. That's institute@socionomics.net. Robert, thank you for this conversation. Let's talk again soon.
Excellent. Appreciate it, Matt. Let's do talk soon.